let's start off with your overall view on the markets and the kind of activity we're seeing right now, where, as I was saying earlier, it's retail investors that are still exerting most of the pressure.
Well, you know, most retail investors are speculative. You rarely do find long-term retail investors. Now, what's happening is that with the inflation edging upwards, there's a lot of pressure. There's a lot of pressure on disposable incomes, where the consumption now takes a larger weight than investment. So, of course, most of the retail investors are on the sales side.
Well, of course, that pressure is coming to the fore, where, as you mentioned, we've got high inflation coming to bear. We've also have this Easter weekend period coming through. So to what extent are we relying on foreign investor interest at this stage of the game? Because we know a lot of their attention is primarily on the blue chip stocks.
Well, we are relying on foreign investors to a very large extent. I mean, look at the activity on East African breweries, the activity on Kenya Power and Lighting, the activity on Equity Bank. Most of the traders there are just foreign investors, and there's currently more institutional investors than individual investors in the market.
Of course, with this, we've had a lot of focus on banks and the kind of lending rates they're imposing on the consumer market in general. Let's take a look at Equity Bank, though, because this is one bank that is looking to pursue drives to bring down its cost base, and hopefully that will translate into something more tangible for the consumer as well. It's planning to outsource the management of its data centers, may lease out some of its capacity as well to reduce the order of running that facility. What are you making of that move from Equity Bank?
Well, it's mainly cost focus. Most banks are currently having a look at the interest rate movement going forward. There's a bit of uncertainty. So I think what they're looking at is probably being in control of what they can in terms of cost. Now, Equity is a mass market bank, which means they really have to leverage on IT in order to be able to distribute their products and services in a cost-efficient manner. So I think going forward, this is a very favorable move for them.
Favorable move. To what extent do you see the other banks coming to the party here and possibly sharing on that infrastructure capacity? Well,
of course, as we go along, there's so many other competitors that are reactive in the banking industry. I mean, we all know how Equity Bank has revolutionized banking. So we'll, of course, going forward, we'll also see Equity's competitors coming up with not necessarily the same arrangement, but with similar concepts in terms of trying to utilize IT as much as possible.
Well, in the meantime, we've had a lot of the insurance players making headlines. Before we get into some of the results that filtered through yesterday, let's take a look at CFC Insurance Holdings. It's to debut on the Nairobi Stock Exchange and comprised, of course, of Heritage Insurance and CFC Life. Before that spin-off, what are you making of the move, and what kind of market reaction are you anticipating to today's listing?
Well, of course, it will generate some interest, but there's still some bit of uncertainty in terms of they really didn't go out doing road shows so as to be able to also meet with analysts in order to enable analysts to understand how to value the insurance arm going forward in order to unbundle, if I may use that word, unbundle the insurance arm from the banking arm. So most investors, I presume, will be taking a wait and see attitude in order to be able to value it correctly.
There has been some positive news on that insurance front filtering through, though, where we had Kenya Re's profit up 16% amidst double-digit sector gains. What did you make of those numbers specifically? Because a specific emphasis by the group made on the fact that it's going to be growing premiums by focusing on even more new markets moving forward.
Well, keenly looking at those results, you notice that even their dividend per share went down. And I think the strategy is to retain more earnings so that they can be able to utilize those funds to penetrate new markets in Africa and the Middle East. And also to boost up their income, you notice that the investment income went up, mainly attributable to strategic asset allocation and also just prudent in investments in order to support their premium income.
Of course, it's not the only player looking at that expansion strategy more aggressively, and possibly on the back of the fact that we've got a pretty immature market, if we can call it that, in Kenya, in that insurance space right now. Taking a look at Jubilee, also strongly on its agenda, African expansion.
Yeah, most of these companies are seeing a lot of opportunity in the region. I mean, there's so much, as you mentioned, in mature markets, under penetration, and you find that as economies grow, as the population starts to appreciate insurance, and as companies expand, doing regional growth, looking at Pan-African growth, of course, insurance demands increase, and these insurance providers just want to position themselves strategically.
How much of a focus is there still on that investment income being reined in by these players, because we know that there still is a pretty big reliance on that front?
Well, I think the tension is much more on the premium income because of competition, of course, because they need to price their products competitively. So you find that investment income for them acts as a support, like a fallback position, in order to be able to have a substantial bottom line. And you find that currently most insurance companies are setting up investment arms. These are roles that previously were done by the accounting department of those insurance companies, but currently they are focusing keenly on investment arms to be able to invest in any free cash flows that they have.